this afternoon. All right, well, let's jump in. Awesome. Thanks, Jed. Let's jump in and look at the task before us on this, at least in northern Colorado here, a absolutely fantastic sunny Thursday. Our topic for today is using profiling. I mean, we're always looking at profiling as a way to approach markets and market opportunities. And in particular today, this is a question that is coming with increasing frequency, and I'm even coming into greater awareness of the need around the desire to go from a scalping trader to a swing trader. And so we'll do some definition around that and describe, what do we mean by scalping trader versus a swing trader, and then how exactly would you make that transition using profiling primarily as a tool to support that. But first, just by way of orientation and introduction, if this is your first time on one of these webinars, you typically try to go through some concepts first, just to give everybody some consistent language, and then from there we'll move on to looking at some live examples, and then have some Q&A at the balance. We will absolutely be done in an hour. If you have questions right out of the get-go, throw them in the question box, and I try to answer every single one of those. And if there are questions that come up, also feel free to throw those in the question box so that we can address those and get as much value out of this time as possible. So I am Josh Schuler. I've had some background in tech and nonprofit. Started with stock flips just as a hobbyist, really, in '09. Introduced equity options to that in 10. Became a full-time trader in 2012, and then I've been a futures trader exclusively as a product since 13. And I'm one of the Market Profile Trading Academy mentors, also a Series 3 commodity broker, working in agricultural hedging and direct managed futures programs. And I live in northern Colorado. There's more to our team, although not on the call today, but a guy that you should know is Matt Davio, who's been a full-time trader for 20 plus years. It's verified Matt had a year that he did 264% return one year, but has done consistently 50% return on capital annual. I think my best year thus far has been about a 70% rock, but he's been doing it for decades. Worked at Parallax and Peak 6, which really probably doesn't mean much to you unless you've been in the industry for a long time, but primarily trades his own book. Matt lives out in Bend, and he was the initial founder of the Trading Academy, and we've rebooted it together here in the last year, and we're rocking and rolling. The central concept when we always do these webinars is that from a philosophical standpoint, I think businesses excel when they can see opportunity before it happens. That if you identify the trend, that you're too late. That it's almost like you're sitting in a car at a red light, you're anticipating the green, and then you go. But like if you're coming to an intersection and it's already green, what's the risk that the thing's going to go yellow and go red on you? I want to be the first guy out the gate. I think that's where the most opportunity is, and I approach that in any business endeavor, but particularly in markets. So we use profiling as a tool, a way to organize market information to allow us to go after that opportunity. So now, with that said as an intro, let's jump into the task at hand around this whole concept of scalping versus swing trading. So I'm going to kind of look at this from pros and cons, because I think there are pros and cons to both scalping and swing trading. Let's start with some of the pros of scalping in loose definition. So from my perspective, scalping is this posture of taking a trade that has a short trade duration. I mean, some of these trades can be 30 seconds, they can be 5 seconds, they could be a couple minutes, but the duration of time is not long. They're typically not as directionally fixed in posture. So bias isn't so much a issue as it is, am I understanding the rotations that are taking place, the how much price is fluctuating, and I'm really focused on price. For the person who likes to be very active, it's awesome because there's lots of action and lots of activity when you're scalping. And it really allows the rule of large numbers to play out. So, for example, if you took a penny and you flip a penny, heads or tails, I mean, you could do it 10 times and it'd be heads 9 out of 10 times. And you'd go, oh, wow, I am awesome. I could always hit heads. But that's a fairly small sample size. If you go out to 1,000 times of flipping a coin, you're going to end up being about 50-50. So the rule of large numbers actually really shows the true performance. So if you've got really good performance statistics in the way that you're trading, you'll probably hit that type of performance and return when you're scalping, because you have so many more trades to work that out. So those are just a couple of the pros of scalping. Probably one more that you could add on there is, it allows you to quickly go to cash sometimes. So if you want to clear the books at the end of the day, you're kind of done, and you can walk away from markets and you don't have to think about it for the next day. Let's look at some of the cons from my perspective around scalping. One is that you have smaller profit targets, that fees eat more into your profits. So if I'm doing more and more trades, that means that I'm paying more and more in commissions. And if I have smaller profit targets, that means that my return relative to my expense, my net income is lower or reduced because of that. You have to be in front of the screens. Scalping is something that you need a quick finger, and you got to be there, and you recognize who the competition is. I mean, you're going to be working against the machines on that. You're going to be, competing with algos. You're going to be competing with HFT, and you really need to have competency around understanding price action. Some people will call it reading the tape or looking at order flow, but you're going to have a great competency around that to scalp and scalp well. And there are some guys that, man, that's their thing, and they eat it up, and that works for them, and that's why they're successful scalping. Okay, so that's scalping. Let's look at swing trading. Swing trading is the idea of looking at positions where you're going to spend more time to get in the trade and be in the trade longer. They could be 5-minute trades. They could be several weeks. And if your pockets are deep enough, they could be several years. But you're looking at a longer-term perspective. You're also looking for a larger profit. And by that and the fact that you're not doing as many trades, you're reducing your fees. So for the number of trades you take, you're looking for larger profits, reduced fees. So the opportunity to make more on fewer trades is there. And because you're looking not so much at just the fluctuating price, you don't really care about that, as you're more directionally fixated. You can trade mobile, or you can trade away from your screen. So it allows you to be able to do other things, whether it's other business interests or just fun or play, that you can't do if scalping is your game. But swing trading does have some cons, and I want to be clear about that, especially if you're one of the guys that just thinks that scalpers suck. It's almost like the swing traders and the scalpers hate each other. There shouldn't be an us versus them. I mean, I think it should be like what works best for you. What's the part that excites you? And if you like a lot of activity, man, scalping is probably something you should check out, and you should go down the order flow and reading the tape and chase that. But if that drives you nuts and it adds to anxiety, then you should probably look at something else. Other cons for swing trading is that fewer trades can lead to longer drawdown periods. What I mean by that is that if you're in the trade and you're waiting for the trade to pull and go against you, you could actually have net drawdown on your account longer, and that does stuff to guys psychologically. It can also put you in a condition where you need to benefit from. Hang on one second, I'm getting alerted here, and it's messing with my focus. All right, back on. It does benefit from deeper pockets. So because you're looking for a trade that you're going to kind of sometimes leg into, it can mean that you're going to have larger capital to own that. If you're scalping and getting in and get out, you can get away with smaller capital. And then from a competence side, you've got to have a directional bias understanding. You got to be able to look at the auction as it's taking place and come up with a perspective of who's in control and where's the auction trying to go. So those are kind of some of the pros and cons. And again, within all of that, and I think that people can be successful doing either. You got to figure out what works for you. From my perspective, and for the other business interests that I have, and the type of trading that I like to do, and serving my clients and being able to teach and stuff like that, I can't scalp. It doesn't work for me. So I found a home in swing trading. So the question is, so if you're in scalping but you'd like to do more swing trading, well then how would you do that? How would you make that transition? All right, here's where you need to take notes. So making the leap. 1, you have to go from looking at price to looking for value. So when you're a scalping trader, you're going to look at fluctuations in price, given over time, and you're just going to look for that price. All that matters to you is price and how fast is it moving. You're looking at momentum. You're going back and forth, and that's the focus. But when you're looking at making the switch to swing trading, you have to start looking for value. And why is that? And then how do you even know what value is? So let's pull out here. We're gonna load, zoom in a little bit. This is a market profile chart with some really cool additional functions to it. But this is showing me, let's go here, let's go back. We're going to merge this. So I'm going to merge all of the trade back to August 22nd. Explain why here in a second. So this whole large composite shows all of the trade from all the way back to 8/22. And we've been ranging back and forth over that period of time. These little letters represent time periods where we have traded at a price. So this is time at a price. So for example, you can see here at 48.47, we've spent more time trading at that price than we have, for example, at 48.42. Now, the way that this is organized shows me that the color intensity is not just time at a price, but also volume at a price. So you can see that we've actually, through this whole area, spent more time at 4,800, but at 48.08 is where the most volume has taken place. Now, most of the time at a price and volume at a price are pretty close. They're in sync. We're a little bit divergent here. But this is showing me where has the market accepted and discerned as value since August 22nd. And I could go in at a later date of why I am looking at August 22nd as a cutoff. There's reasons behind that, so don't read too much into that. But I'm looking at this as a place to gauge entries and exits and where do I want to play, because I know that there's a perception of value, and value meaning people are willing to accept that price. It's the same thing as if you were shopping for any product. It's like shopping for a car, for example. If you're looking for a truck, you want to go buy a truck. There are so many models of makers of trucks out there, but there are some fairly consistent pricing based on features, horsepower, torque, engine size, that when you compare apples to apples or get as close to as possible, that the price is fairly consistent. And the reason for that is because there's an acceptance of value around what that price allows you to get. You may see someone come out with a price that's much higher than that, but if nobody else can sell a product at that price, where's the price going to go? It's going to go back to this place of value. So one of the first things that you have to do when you're looking at moving from a scalper to swing traders, you have to start being able to discern where is value. And value can change, and where value is can be different based on your time frame. So this is an area of value over the last month or so I personally have been using this area as a place to buy because I can use this zone and test back into this zone as a place to buy and get long. You actually will see that today, let's expand this profile and you'll see what I mean. Notice this is the open today at 48.62. We sold off. Look where we came right back into. We came into an area where there was acceptance of value and found buyers. Do you think it's a coincidence that we found buyers down there? Absolutely not. It was going to be expected that we would find buyers. That's why the auction was held up in this area, is because we got closer to this fairest price by volume and fairest price by time and found buyers. They were going to defend that. Now, if that had not held, then you would know that something big had changed in the market. But that was what happened today. And so from a swing trade perspective, you had really great trade location in entries between 48.15 down to 4800, and you end up getting back up here to around 48.45. A 30-point move in the NASDAQ on one contract is $600 in profit or loss if you trade one contract of that product. So you could, start thinking, well, how do I make $600 a day trading? You can either scalp back and forth, back and forth, and back and forth and try to do that, or you can take one trade using less capital, placed in the right spot, and net that. So that's a way, but you can only do that not by just looking at time or price, because price is irrelevant. It's volume at a price or time at a price that helps you identify zones. And the reason that this is important is because there's predictable behavior that occurs in areas where we spend lots of time at a price relative to areas we don't spend lots of time or volume at a price. So, like for example, today you can see we moved a lot back and forth across kind of this 48.42. See, there's a valley here, both in time, and this is a composite volume profile as well of the last number of days. You can see that there's a valley here. Actually, I need to make sure my cumulative is set correctly. That we just go back and forth. That's because in these low time areas or low volume areas, the behavior is that we'll either cut right across it or we'll come into that area and snap back out. But when you have an area where there's lots of acceptance, what you find there is that it'll actually slow the trade and give you an opportunity to make a decision. So knowing those zones and being able to identify those zones allows you to anticipate, i.e., see the opportunity before it happens, and start to build a hypothesis of, hey, what am I going to do when it gets to this zone or that zone? So that's a way that one can use profiling to move from scalping to swing trading. And it starts by looking at value, not just price. The second part of this and making the leap is not just go from looking at price to looking for value, but to know the difference between what could happen and what's likely to happen. Knowing the difference between what could happen and what's likely to happen. Now, here is why this is very key in swing trading, is because there are predictable behaviors in the market. It doesn't mean that there aren't times when those behaviors get thrown out the door. Here's a chief example of this. Go back over here. Okay. Notice on today's profile in the NASDAQ, see this green line here? This is what we call the initial balance. This is the first hour of trade. So probably didn't know this, but there is a 90% probability that we will extend the range past that first initial hour's range every day. So if that range today, for example, was from 48.70 down to 48.46, there's a 90% probability we were going to exceed one of these two prices. Okay. Now, how you know which one it is, that's for another time. But knowing that you could exceed one of those and that's likely, There are times when we don't, and there are different things that you do there. But knowing that that's likely gives you an edge in terms of seeing an opportunity before it happens, and even what type of trade position would you want to take, and who's in control on that day. So, for example, today we broke it in D period. Well, actually, we broke it in C period. So if you did that, that told you something. That told you, for example, that other time frame sellers are in control, and you could start to establish a short bias. It actually allows you on this rally in F period to sell this thing. So when everybody looks like, oh, it's going to rally, we're going to go new highs. But the thing is that 90% of the time, not only does it extend the range, but it only extends it in one direction. In one direction, not both. So if once I had seen range extension today, I can start looking for any rally to sell because I know that it's not likely that we'll extend the range to the upside. Now, if we do, then my hypothesis is off, and I need to do something else. But that gives me an opportunity to, start looking for a place, and it's built on what is likely to happen, not what could happen. And the number of times that I see traders who put trades on, and their best strategy is hope. And they'll say, oh, well, I'm hoping for a rally, or I'm hoping that we're going to hit new highs. Guys, that doesn't work. It's not a long-term sustainable trading perspective. What is long-term trading perspective sustainable is that when you can identify probabilities and parse out the difference between what's likely to happen from what could happen. Yes, we always have contingencies for what could happen. And on this specific example, now I did not trade the NASDAQ today, but had I done that, I would have said, okay, well, if we get above this, extend the range to the upside even after I started short, then my hypothesis and reason for getting in is off, and I need to either exit the trade or reassess. But I have to have that conversation, and I have to be very clear, because if the hypothesis was built on it's only going to extend in one direction, and then that changes, then your reason for being the trade is no longer valid, and you need to reassess. Because otherwise you could say, well, it's going to turn around, but again, then something different is in play, and we could go the total direction, and some of the probabilities get thrown out the window. So you've got to be able to know the difference between what could happen and what's likely to happen. Next thing on this is to be able to identify zones where you can define risk. Okay, so let's look at an example of the trade that I was in today. I'll pull this one over here. So this is crude oil. I'm looking for zones that I can identify risk. So one of the things that I track every day is the average trading range of any instrument that I trade. You can very quickly figure that information out. Most platforms have an ability for you to actually add that to a watch list where you can see what the average trading range. If you're going to set the width of how long that is, I suggest about 20 days. Some guys will say 50 days. Just pick one and be consistent. And the average trading range right now for crude oil is about $1.60, $1.70 in move. Okay, so and this includes the entire session, so Globex and the real-time session. So if you're looking at this chart, for example, I'm going to make sure that I can see my crosshairs so we can see this clearly. But you'll notice that the low of the overnight session was here at 46.60. All right, let's look at this. So 46.60 plus $1.60 gets you to 48.20. 48.20. Notice where the high of the day was. Now, is that a coincidence? No, it's not a coincidence. It is actually the expected behavior. Could we exceed that? Absolutely. Yesterday in crude, we saw $3 range. Massive range. What fueled it? OPEC news, something completely unexpected. But so today, I was looking for I did not buy crude, even though I saw that the bias was bullish, but I just didn't see a good entry. So what I was looking for was a counter trend trade later in the day, and a counter trend swing trade, for example, later in the day. So I'm going to break out this profile so you can kind of see this on a 30-minute. So again, we had identified that the average trading range got us up here to 48.20. I actually started in front of this because I could have been early, but I was selling right under 48. That was kind of my first entry. I was willing to sell up to 48.30 area, which is right here. And I was using the average trading range as a way to help me define the risk. So when I say that you have to identify zones where you can define risk, the other part of that is that on a larger term chart, this 48.35 area, see how volume just starts to taper off? So the participation in this auction is exhausting as we go higher. So to go higher, you got to have more people participate. And this was telling me on the profile that we were not getting more. So I have two things lining up. I have the average trading range that's going with me, and then I also see that volume is dying off at a price. Volume at price is dying off. So that's telling me, hey, I think that, again, this is my hypothesis, but I believe that the auction is exhausting. I'm going to define this area to get in, and here's where I'll start, and here's where I'll put my last bid on, and if it doesn't pull, then I'll get out. And for me, that was if we got to 48.50, which exceeded that average trading range, then I was wrong, and I would start peeling off the trades. But we, in fact, got to 48.30, and then that at that point, my cost basis was at 48.15. I peeled some off at 47.90. I peeled others off at 47.75. Absolutely exceptional trade. It worked out, and again, it was based on a defined risk. Could it have gone against me? Absolutely. Do they go against me at times? Absolutely, they do. But I have more winners than losers, and the reason for that is because I know what's likely to happen, not what's could happen. It was most likely today that in that area we were going to start to see some sellers. Okay? So that's where profiling allows you to define zones where you can identify risk. If we go back to that NASDAQ example in that 48.06 area, that's an area where you could say, hey, look, I'm gonna buy down in that area, and I know that I'm wrong if we get daily closes below it. So I'm defining an area of risk where I'm willing to take some heat to get into the trade, and then I'm looking for the likely behavior that we're going to find buyers in that area, and we'll move forward. So that's what I mean by using the profile to help you identify zones where you can define risk. Here's another thing that's crucial in making the leap from scalping to swing trading is that you're sizing the account appropriately to the risk. Okay, so however much capital you have to look at, okay, well, and how much heat can I take on that trade, or willing to take on that trade, and when is too much, too big. As a general rule of thumb, I never put more than 40% of my capital on a trade on a day time frame. I never carry more than 20% of capital in a trade overnight, for the reason that this allows me opportunity to move and navigate and adjust, but also because I'm trying to size my account and risk appropriately to each other. This also helps me not get in the position of where I just keep adding to a position, or you may have heard someone call it averaging down on the loser. This idea that, hey, if I just keep chasing this thing in a direction, I keep adding and adding and adding to the position, eventually it's going to turn. Most of us don't have pockets deep enough for that strategy to work. Now, if you're Deutsche Bank, if you're if you're Credit Suisse, you do, but that's not you and me. So sizing your account appropriately risk, and I don't have a whole lot to give you on this, other than you could say, all right, well, how much capital I have, how much does it cost to put on a single trade? What is that ratio? Again, I think it's healthy to have it be less than 50%. I would never put a full position on a trade, or full capital on a trade. I just don't think that's wise. And then, what if I start with, for example, if I start with 1, what's the max position that I'll put on a trade before I start pulling them off? Is it that I can do 3 contracts? That I can do 5 contracts? Is that going to do 25? Again, that's sized appropriately to your risk, keeping within kind of a framework of hey, I want to stay south of 20% in any given trade of my capital, or under 40% at kind of that full size. So that's another key point. Lastly, have targets and stops defined before entering the trade. So this is a challenge, especially if you're a scalper and you are used to watching the momentum of the price action, and then you're looking to move to swing trading, because you could be in a position, have the trade go against you, and then because you're watching the momentum, you'll actually start messing around with the position, maybe adding stuff to it's a whole number of behaviors that you see in that. But if you're entering it and you know, hey, here's where I'm wrong, here's the target that I'm looking for, and you're having that before you get into the trade, and you're identified that. If you get in the trade and it goes against you, and then someone would say, oh, well, what was your target? And you're like, I don't have one, or you come up with one, then I hope you have the self-awareness to know that you're out of step with reality and you should exit the trade. Let me give you a very tangible example right now. Looking at live cattle. So this is a December contract on live cattle. I have targets up at the 107 to 108 levels. Okay, so you can see the build out in the volume at price up here at 108, also here at 107. I am long cattle at 103.025. We closed today at 102.875. And one of the things that I was watching for, and I was expecting range extension to the upside today. We got that. So you can see we extended the range here to the upside. However, late in the day, notice what we did. See these two little blips? We extended the range to the other side. So what this tells me is, yes, there was other time frame buyers here, but there are also other time frame sellers. And when I look at value, or the value areas from one day to the other, this blue area being 70% of where volume at a price took place, it's inside of the prior day. So while I was coming in looking for some really good directional conviction, what the profile is actually showing me is it's not there. So I'm going to be very, very careful with my long tomorrow. And in fact, if I get a pop up, I'm going to put a flat stop on this. I don't want this thing to go against me. If we flush early, I'm going to just dump the thing. And I've already determined that that's what I'm going to do based on what the profile did today, and knowing that my hypothesis was based on the continued, I bought it on this day. I bought it yesterday. I was watching it today. In fact, at one point, I was way up. Okay, so just for reference, for example, a 1-point move in cattle is $400 per contract. So, for each contract, I was $400, to the positive. I'm about $60 to the negative each contract right now. But given the prior day's profile, I was looking for higher value today and a higher close. We actually got a lower close today than yesterday, value inside. So there's a number of things stacking up to say, hey, the hypothesis of why you got in this trade is now in jeopardy and in question, so you need to take a different approach. So, and I had defined that before I entered the trade. When I had these clear targets up here at 106. Oh, that's awesome, right? Because if you're at 103 and you get to 106, that's $1,200 per contract in profit. That's awesome. But where am I wrong? So whenever you're getting in, from swing trading to scalp trading, you have to be able to identify, okay, how do I know where I'm wrong or right? It's not as clear cut as a lot of guys who scalp, where they'll say, hey, I have a set, if you're trading bonds, I have a 2-tick stop and I'm going to go for a 6-tick target. It's not that cut and dry, because when you're talking about swings, you're going to see price moving in wider areas. So you're looking for more zones, you're looking for confirmation to get out of the trade, and you may find that if you're trying to tighten the risk so tight as in 6 ticks or 10 points or stuff like that, you're going to get stopped out a lot of a very valid trade. So you're still going to identify where you're wrong, but the perception of that and how that's defined is going to be a little more loose than what you may be used to if you're a scalping trader. So that is kind of my 5 points on how to make the leap from scalping to swing trading. We looked at some examples. What I'd love to know is, hey, are there any questions that anyone has, or they want to look at a specific product, and we can kind of identify some zones. We can apply all of this. We can look at some areas of value. We can talk about what's likely to happen. We can identify some zones and some sizing, and where they know that you're wrong. And that would be kind of the balance of what we'll do today. So I'm going to grab some water here for a second. let anybody who wants to throw a question in do that. Oh, and by the way, if there's not any questions, then I'll wrap this thing up here in 5 minutes, and I will get out of the office and get ready. I'm flying tonight, catching a red eye to the East Coast, so I will gladly get out of here early if everybody's ready to go. Yeah. Okay. Let's look at the ES, shall we? That absolutely, we can look at that. So let me close this one. No, let's keep this one open. Pull that one over here. While I'm doing that, by the way, this, if you want to know, this product is called Window Trader Blue, which is an exceptional platform for technical analysis using profiling. And I use it in tandem with another software called Investor RT. So we're going to look at ES here. And I'm going to open, well, I let the ES pull up in Window Trader. So let's kind of start some analysis looking here at the ES. So what you're looking at is these are 30-minute candles. Each of these gray profiles represent 1 week. So this is the volume at price profile for a given week. These are daily profiles here. So this is a 1-day volume at price profile for the ES. This is, in fact, the total session. You can see the gray bars here are the overnight session. Here's the daily. And then this is a 20-day composite profile. This is a 5-day profile. So by tomorrow, this profile will sync up with the weekly profile. But let's just talk at a very high level. We can look out here at a daily chart. You can see this is a 3-month. I'm sorry. This is a 3-month profile. This is a 9-month profile in the ES. So one, notice where we are. Notice that on a 9-month basis on the composite. Oh, there we go. We have value here. The point of control is 2153. There's also a node here on the 3-month point of control there is 2173. You do get different perceptions of value again in different time frames. And get this loaded. Let that rock and roll while we're waiting. But really, we've been in the same prices in the ES really all the way back to the early part of July. You can see that we've really been in a range. There's a clearly defined low volume area here and a broadly large area of balance here. So this is not a directional market. This is what I call a balancing market. The opportunities definitely favor traders, not necessarily buy and hold investors. Okay. All right, so let's look here in Window Trader. And let's just look at some comments on today. Similar to the NASDAQ, we have kind of a range that we had tried to break out. You can see these breakout days here that we've come back into. If I include these, it becomes a little bit closer picture. So similar to the NASDAQ, you can see we came down into this zone, found buyers. Now there's some interesting things going on in the fact that we had a very tight initial balance. We got range extension to one side. Again, there's that 90% probability. So it definitely favored the shorts, but you at the larger time frame. So it favored the shorts on the day time frame, but on a larger time frame, we're still holding support. So for example, tomorrow in the ES, what I'd be looking for is, man, can we get, can we basically stay above this zone if we can, I like to buy any areas into this zone until it fails. And failure would be that we'd have either a gap down below this area or we just slice right through it. Typically, that's the kind of stuff that comes off of some type of news. Not necessarily it's the specific news that's that important, is that they're just using it as a trigger. But I'm looking to play that. And then within ES, let's see what the current. So right now, ES is doing about 23 points a day. We did 29 points today. So 23 points on average. We did 29 points today. So given wherever we open, I'll look for how we establish in the initial balance, and where do we extend the range, and then try to plot from there to see where the opportunity is. One other thing I would say about swing trading in terms of like a goal on a day is I try to capture about 25% of the range if possible. If I think that's kind of an A+. So if the average range right now in the NAS or in the ES is about 23 points, then if I can capture 6 points, I'm a rock star. If I capture more than 6 points, I'm really a rock star. But from a swing trading perspective, that's a great way to look at it. You don't have to be perfect. It's why I actually trade the NASDAQ more than I trade the ES, because the NASDAQ on average is wider than the ES, and provides, in my mind, more opportunity. And we could go into that at some other point. But for where the ES is, I mean, I was really looking for a break and sustained move out. It doesn't look like we're getting that. So I don't know if we're going to keep testing this until we finally get enough momentum to get out of this area. But for the time being, I'm looking to buy into the zone, and my targets are up here, 2170 and higher. So hope that helps, Mike. Any other questions? This is your time, so fire away. I asked it to do too much. So let's look at soybeans here. Notice that we're in a range. See how we've been. And this one, another one of the reasons I love market profile as a tool to help you see the market. I think, can you successfully swing trade without market profiling or volume profiling? Yes, but it feels to me like you're doing it with one hand wrapped behind your back. This is just showing me that really from 993 to 937 is the playground. And we've tested the 937 a number of times. We find buyers every time, and we just keep playing around here. So if I zoom in even further and I look at the last 4 days, notice here this build out a price at 947. That's the highest volume and time that we've spent. So right now we closed above that. I think until we get closes below 945, that there's an opportunity, given that we're in this larger range, to get a swing trade that goes up to 960, 974. I mean, those are the targets. If you can convert that to raw dollars, every point move in the soybeans is $50. So if I'm going from, basically if I go a dime, if I go 10 cents from, if I could buy 48 and I could get to 58, that's $500 a contract. If I get to 68, that's $1,000, in terms of profit. So that is, pretty awesome, pretty nice return, and that's on one contract, just one contract. So you can start thinking if you had, multiple contracts, and then it's a fairly defined risk area. I'm basically saying, look, I'm above this zone. This is an area that should support me and hold me up. And if we get closes below that, then I'm wrong. I'll take the trade off. It's that simple. I mean, you say it's not that simple. It's hard. It's hard when you're in it and your emotions are wrapped in it and you're in the trade. But that's another example of using the profile to help you look for value, to define the risk, to be sized appropriately, based on that risk, and move in that way. All right. Well, I'll tell you what. I don't see any more questions coming through, so that is totally fine. Let's wrap this puppy up. Want to let everybody know that we have launched successfully our 3-session quick launch workshop. It's 3 sessions. They're standalone, but they all together make one whole perspective. The whole idea is to help you figure out if trading is for you, and whether it should be your business, it should be something you invest in, or whether you should go invest your time and effort in something else. But we have these 3 workshops we do, or 3 sessions that make up the workshop. We do them 4 times a year. The next 2 sessions that are coming up is session 2 on October 12th and session 3 on November 2nd. Go to Market Profile Trading Academy /workshop to find out more information about that. We do have a Slack team that is looking at markets from the profiling perspective, and also most of our swing traders. We do have some scalpers in there as well, but even the scalpers are using profiling as a way to help them. So you can go to our website, contact us, ask for an invite to the Slack team, and we'll get you going. And it's like chat, but it's cool. It goes to all your devices and notifies you, and we can drop charts in there. It's a blast. So check that out. And then finally, we do free consults. So if you're a scalp trader and you want to just kind of talk through even some of the principles that we talked about in this webinar, hey, set up a free consult with Matt and myself. It's really easy. You can go to back out of this. You can go to calendly.com/MPTA, and you can click on free consult, and then check this out. You can pick a day and time that you want to have a consult, and you can schedule it. And we'll call you at that time, and we'll give you a free half hour just to look at whatever. So, I've set up blocks where I allow for this to be scheduled and try to help. But, that's a resource that not a lot of people know is out there, but hope you take advantage of that. All right, that's it. That's my read on how to make the transition from scalping to swing trading. We talk more about this specifically with even more details and predictable frameworks in session 3 of our quick launch workshop, and that'll be on November 2nd. So check that out if this piqued your interest. Sign up for a consult if that is interest to you, or ask to get in the Slack team. Do what you need to be successful in this business. And it is a business. I think you need to approach it that way. And if you're looking to make the transition from scalp to swing, we can help you get there. All right, everybody. Thanks for the time. Thanks for the attention. And we'll catch you for our next webinar, which will probably be in another 2 weeks with a new topic. All right. Peace. Have a good night.